Bitcoin ETFs solved one of the biggest barriers to investing in Bitcoin. You can now gain exposure through a normal brokerage account without opening a crypto exchange account, managing a wallet, or protecting a recovery phrase. That convenience is real, but convenience and safety are not the same thing. When you buy a spot Bitcoin ETF, you remove the responsibility of personally securing private keys. In exchange, you become dependent on a larger financial structure involving a broker, stock exchange, trust sponsor, custodian, market makers, authorized participants, and Bitcoin trading counterparties. Bitcoin's price volatility remains. The ETF does not transform Bitcoin into a stable asset, guarantee accurate tracking, or protect the investor from a major decline. It also introduces risks that do not exist in exactly the same form with direct Bitcoin ownership. The ETF trades during stock market hours, while Bitcoin trades continuously. Its market price can move above or below the value of the Bitcoin held by the trust. Fees gradually reduce the amount of Bitcoin represented by each share. And the investor must rely on institutions to secure the underlying asset and keep the creation and redemption system functioning. This does not make Bitcoin ETFs inherently bad. For many investors, the operational convenience may be worth the additional layers. But the correct comparison is not risky Bitcoin versus safe Bitcoin ETF. It is direct Bitcoin risk versus Bitcoin risk packaged inside a financial product with its own structure, costs, and dependencies. To understand those dependencies, we first need to clarify what kind of product a spot Bitcoin ETF legally is. A spot Bitcoin ETF may appear beside stock and bond ETFs inside the same brokerage account, but the legal structure is different. Traditional stock ETFs are commonly registered investment companies operating under the Investment Company Act of 1940. Spot Bitcoin products are generally structured as exchange-traded commodity trusts. They are registered securities and trade on regulated exchanges, but they are not traditional 1940 Act investment funds. That distinction matters because investors should not assume every rule, governance requirement, or investor protection associated with a conventional mutual fund or stock ETF applies in exactly the same way. A traditional equity ETF may hold hundreds or thousands of securities, operate through a board structure, and follow diversification or investment company requirements. A spot Bitcoin trust primarily exists to hold Bitcoin, issue shares, and calculate the value represented by those shares. Its prospectus defines how Bitcoin is valued, who protects the private keys, how fees are paid, which institutions can create or redeem shares, and what happens during operational disruptions. The product is not unregulated, but regulated does not mean identical to every other ETF in the brokerage account. The familiar trading interface can make the structure feel simpler than it actually is. Investors may compare only expense ratios and recent performance while ignoring the trust agreement, custody arrangement, and benchmark methodology. The ticker tells you how to trade the product. The prospectus explains what you actually own and which risks you are accepting. And that leads to the most basic ownership distinction. Buying a Bitcoin ETF share is not the same as owning Bitcoin directly. When you buy a spot Bitcoin ETF, you own shares in a trust that holds Bitcoin. You do not personally control the private keys protecting that Bitcoin. You normally cannot send the underlying asset to another wallet, use it for an on-chain transaction, or redeem one retail share for a specific amount of Bitcoin. Your direct asset is the ETF share. The trust owns the Bitcoin, and an institutional custodian is responsible for protecting the keys. Large financial institutions, known as authorized participants, help create or redeem blocks of shares, but ordinary investors usually enter and exit by buying or selling shares on the stock exchange. This structure provides clear advantages. There is no seed phrase to lose. The holding can appear beside stocks, bonds, and retirement assets. Tax reporting may be easier than documenting activity across multiple crypto wallets or exchanges. But the investor gives up direct control. A self-custody holder decides where the Bitcoin moves and when a transaction occurs. That control comes with full responsibility for securing the keys. An ETF investor transfers that responsibility to a chain of institutions and accepts the rules established by the trust. Neither arrangement eliminates risk. Self-custody creates personal operational risk. The ETF creates custodial, legal, and institutional dependence. The important question is whether you want direct control over the asset or financial exposure through a tradable security. That difference becomes especially visible outside normal stock market hours, because Bitcoin continues trading even when the ETF is closed. Bitcoin trades 24 hours a day, 7 days a week. A Bitcoin ETF does not. It normally trades when the stock exchange is open, with limited additional access during supported pre-market or after-hour sessions. That difference creates market hours risk. Imagine the ETF closes on Friday afternoon. During the weekend, a major regulatory announcement, exchange failure, or large market liquidation causes Bitcoin to move sharply. Direct Bitcoin holders can trade while the event is unfolding. The ETF investor may need to wait until the stock market reopens. When trading begins again, the ETF price can gap significantly above or below Friday's closing level. A stop order does not guarantee protection from that gap. The order may execute only after the market has reopened at a very different price. The same issue can occur during the week overnight. Bitcoin may react immediately to global events, while the ETF remains unavailable. This does not mean continuous crypto trading is automatically an advantage. 24-hour access can encourage impulsive decisions, and crypto exchanges introduce their own liquidity and counterparty risks. But the ETF creates a specific limitation. The asset underneath the product can move for many hours before the investor can adjust the position. For a small long-term allocation, this mismatch may be acceptable. For a concentrated position, a leveraged strategy, or an investor expecting immediate risk control, it can become much more important. And even when the ETF is actively trading, its price does not have to match every Bitcoin price displayed across the internet. That brings us to tracking risk. There is no single universal Bitcoin price. Bitcoin trades across many platforms in different currencies and with different levels of liquidity. A spot Bitcoin ETF normally uses a defined reference benchmark calculated from selected market data. The trust then calculates its net asset value based on that benchmark, the Bitcoin it owns, and the liabilities or expenses it owes. Finally, the ETF shares trade on a stock exchange at a price determined by buyers and sellers. That creates at least 4 related numbers: the Bitcoin price displayed by a crypto application, the reference benchmark used by the trust, the net asset value per ETF share, and the actual market price where the ETF is trading. Under normal conditions, these values may remain close, but they are not guaranteed to be identical. Sponsor fees create gradual tracking drag. Bid-ask spreads affect the price an investor actually receives. Strong buying demand can push shares slightly above net asset value. Selling pressure can push them below it. Temporary disruption in the underlying Bitcoin market, the benchmark, or the creation and redemption process can increase those differences. An investor may therefore be correct about Bitcoin's direction and still receive a slightly different result through the ETF. Tracking risk is usually less dramatic than Bitcoin's own price volatility, but it becomes meaningful over long holding periods and during stressed markets. To understand why ETF prices normally remain close to the underlying Bitcoin value and why that connection can weaken, we need to look at the institutions operating behind the ticker. Buying a Bitcoin ETF may require one click. Making that share function requires an entire institutional system. The retail investor submits an order through a broker. That order reaches the stock exchange, where market makers provide bids and offers. Authorized participants can assemble or redeem large blocks of ETF shares to help keep the market price close to the trust's underlying value. Depending on the fund's approved process, cash or Bitcoin then moves through designated counterparties. The trust relies on a custodian to secure the underlying Bitcoin. It may also rely on a cash custodian, benchmark administrator, trading counterparties, transfer agent, and other service providers. When demand for the ETF rises, authorized participants may create new share baskets. When demand falls, they may redeem baskets. This arbitrage process helps connect the ETF's market price with the value of its Bitcoin. But every connection is also a dependency. A market maker can reduce activity. An authorized participant can step away. A trading counterparty can face operational or liquidity problems. The custodian can experience a service disruption. The benchmark can be delayed or affected by poor market data. Under ordinary conditions, investors may never notice this machinery. During stress, those relationships become much more important. The ETF eliminates the need for the investor to manage a private key personally. It does not eliminate operational risk. It reorganizes that risk into a financial structure, and when parts of that structure become less effective, spreads, premiums, and discounts can expand. During normal trading, a liquid Bitcoin ETF may have a narrow bid-ask spread. For example, buyers might offer $99.95 while sellers ask $100.05. The difference is small and the market price remains close to net asset value. During market stress, that relationship can change. Market makers may become less willing to hold risk. Authorized participants may face higher hedging costs. Liquidity in the underlying Bitcoin market may weaken. The ETF spread can widen and the shares may trade at a premium or discount to the estimated value of the Bitcoin held by the trust. In a simplified stressed example, the highest buyer might offer $97, while the lowest seller demands $103. The investor now faces a much larger trading cost. Creations or redemptions may also be delayed or temporarily suspended under certain extraordinary conditions. When the arbitrage process becomes less efficient, the ETF price can move further away from net asset value. Retail investors cannot normally solve the discount by exchanging one share directly for Bitcoin. They depend on institutional participants to restore the connection. This does not mean the ETF structure is always fragile. The mechanism is designed to keep prices aligned and often works effectively. The hidden risk is that alignment is a process, not a law of nature. It depends on liquidity, willing counterparties, and functioning markets. One of the most important institutions inside that process is the custodian, and transferring Bitcoin to institutional custody does not make private key risk disappear. Direct Bitcoin ownership requires the holder to protect private keys. Lose the keys and access to the Bitcoin may be permanently lost. A Bitcoin ETF transfers that responsibility to an institutional custodian. The custodian may use cold storage, geographic separation, access controls, transaction approvals, and other security procedures. For many investors, that institutional system is more practical than managing personal wallets. But the underlying Bitcoin still depends on private keys. Those keys can theoretically be lost, compromised, or misused. A cyber attack, insider event, operational failure, or defective security procedure could affect the trust's assets. Insurance may provide some protection, but investors should not assume every possible loss is fully covered. Coverage can be limited, shared across multiple clients, subject to exclusions, or insufficient for an extreme event. Bitcoin held by a trust is also not equivalent to an FDIC-insured bank deposit. The investor is relying on the custodian's security and on the trust's ability to recover from a failure. The key distinction is risk transfer. With self-custody, you control the asset and carry the personal security burden. With an ETF, the custodian controls the keys and the investor carries the institutional custody risk. For many people, that trade may still be worthwhile, but it should be understood rather than treated as complete risk removal. And understanding the product instead of accepting the simple marketing narrative is exactly the purpose of this channel. If you prefer crypto analysis without guaranteed adoption stories or daily Bitcoin price prophecies, subscribe to Boring Money Wins. Bitcoin ETFs can be useful products. They provide brokerage access, liquidity, and a practical way to hold Bitcoin exposure inside certain retirement or investment accounts. But a convenient product should still be analyzed through its structure, custody model, fees, and failure points. The question is not whether Bitcoin ETFs are secretly terrible. The question is which risks were removed, which risks remained, and which new risks were added. If this video is helping you understand the product behind the ticker, click the like button. That helps YouTube recommend the analysis to more investors who are considering Bitcoin ETFs without fully understanding the legal and operational structure. Crypto discussions often become a choice between extreme optimism and extreme pessimism. A serious investment decision requires neither. It requires understanding volatility, controlling position size, and knowing exactly what you own. So far, we have examined trading hours, tracking, institutional dependencies, and custody. The next risk appears much quieter. It does not require a cyber attack, failed counterparty, or market crisis. It operates continuously, even when everything works exactly as designed. The sponsor fee is normally paid from the trust's assets, which means the amount of Bitcoin represented by each share gradually declines over time. A Bitcoin ETF charges a sponsor fee for operating the trust. That fee may appear small as an annual percentage, but it is not usually paid through a separate invoice sent to the shareholder. The trust uses its assets to cover the fee and other permitted expenses. In practical terms, Bitcoin may be transferred or sold, causing the amount of Bitcoin represented by each share to decline gradually. Suppose Bitcoin's market price remains completely unchanged for several years. The ETF can still trail a theoretical fee-free Bitcoin position because each share represents slightly less Bitcoin over time. When Bitcoin rises sharply, this reduction may be difficult to notice. The ETF can show a strong positive return while still underperforming direct Bitcoin by the cumulative effect of fees, expenses, and tracking differences. The longer the holding period, the more the recurring fee matters. A small annual drag compounded over 10 or 20 years can become meaningful. Fee waivers can also expire, and different funds may apply different expense structures. Investors should compare the current fee, the permanent fee after any waiver, and the fund's actual tracking history. Paying a fee is not automatically unreasonable. The investor receives brokerage convenience, institutional custody, market liquidity, and simplified access. The mistake is treating that convenience as free. A Bitcoin ETF is not simply Bitcoin placed inside a brokerage wrapper. It is Bitcoin exposure with an ongoing operating cost, and accurate tracking also depends on the quality of the fragmented Bitcoin markets used to calculate the fund's benchmark. The Bitcoin ETF trades on a regulated securities exchange, but the Bitcoin used to value the trust trades across a fragmented global crypto market. Different platforms can show slightly different prices. They may have different trading volumes, customer bases, regulatory standards, and operational reliability. The benchmark used by the trust normally combines information from selected trading venues through a defined methodology. It may use volume weighting, time windows, outlier filters, or other procedures designed to create a representative Bitcoin price. That process can reduce the effect of one unusual trade or one unreliable platform. It cannot remove every underlying market risk. A major platform can experience an outage. Trading volume can become concentrated. Market data can be delayed. Regulatory action can disrupt liquidity in a particular region. Manipulative activity or distorted volume can affect parts of the broader market. The benchmark administrator and trust sponsor attempt to manage these risks through methodology and venue selection. But the ETF wrapper does not rebuild the Bitcoin market underneath it. It still depends on that market for price discovery and liquidity. This is another example of the difference between product regulation and asset market maturity. A well-structured security can provide exposure to an underlying market that remains volatile, fragmented, and operationally complex. The benchmark may be robust without being perfect, and the ETF may track that benchmark accurately while still depending on a Bitcoin market carrying its own risks. Direct Bitcoin holders also participate in that market, but they may have access to certain blockchain-related economic rights that the ETF investor does not automatically receive. Forks and airdrops provide a clear example. A blockchain fork occurs when the network separates into different versions or rule sets. A direct Bitcoin holder controlling the private keys may gain access to assets on both chains, depending on wallet support, network conditions, and the technical details of the fork. That does not mean every forked asset will be valuable, safe, or easy to claim, but the holder may have the ability to make that decision directly. An ETF shareholder does not control the trust's private keys. The sponsor and custodian determine how the trust responds. They may recognize one network as Bitcoin. They may sell, distribute, ignore, or permanently abandon rights associated with another chain. The same issue can apply to airdrops or other incidental digital assets. Trust documents may give the sponsor broad discretion and may allow the trust to abandon assets when holding or distributing them would create legal, operational, or tax problems. As a result, the ETF shareholder may receive no economic benefit from something that a direct holder could potentially claim. This is not necessarily a major financial loss. Many forks and airdrops eventually have little value, and claiming them can create security and tax complications. The important principle is that price exposure does not guarantee every right associated with direct asset ownership. The trust decides which assets it can support within its legal and operational structure. This reinforces the central trade-off. The ETF simplifies ownership by limiting what the investor controls. To decide whether that trade is appropriate, it helps to compare the ETF directly with exchange custody and self-custody. There are three common ways to obtain Bitcoin exposure, and each moves risk to a different place. The first is a Bitcoin ETF. It offers easy brokerage access, familiar trading, and potential availability inside retirement accounts. The investor does not manage private keys. In exchange, the investor accepts sponsor fees, stock market trading hours, tracking differences, custodial dependence, and the trust's rules. The second is holding Bitcoin on a crypto exchange. The investor gains 24-hour trading and may be able to withdraw the asset to a personal wallet. But while the Bitcoin remains on the platform, the investor depends on the exchange's custody, solvency, liquidity, and withdrawal systems. The third option is self-custody. The holder directly controls the private keys and can transact on-chain without waiting for a broker or fund sponsor. There is no annual sponsor fee, but the holder is completely responsible for backup, security, transaction accuracy, and inheritance planning. One mistake can be irreversible. No method removes every risk. The ETF replaces personal key management with institutional structure risk. The exchange replaces direct control with platform counterparty risk. Self-custody removes some intermediaries but concentrates operational responsibility in the individual. The correct structure depends on the investor's priorities. Convenience, control, cost, account type, technical ability, and security responsibility all matter. The mistake is choosing based only on expected Bitcoin returns. Before asking how much Bitcoin may rise, decide which risks you are qualified and willing to manage. That comparison gives us the framework for the final verdict on Bitcoin ETFs. So, are Bitcoin ETFs a good way to own Bitcoin exposure? They can be. They improve brokerage access, exchange liquidity, retirement account compatibility, and convenience for investors who do not want to manage private keys. But those benefits come with additional structural risks. The ETF trades on a schedule, while Bitcoin trades continuously. Its price may temporarily move away from net asset value. Fees gradually reduce the Bitcoin represented by each share. The investor depends on custodians, authorized participants, market makers, counterparties, and benchmark providers. Forked assets or airdrops may provide no benefit to shareholders, and none of these structural features removes Bitcoin's underlying price volatility. Before purchasing a Bitcoin ETF, ask 5 questions. What legal structure am I buying? Who holds the private keys? How are shares created and redeemed? What fee and tracking drag will I pay? And how large can the position become without threatening the rest of my financial plan? The ETF can simplify ownership. It cannot make an oversized Bitcoin position responsible. The total risk comes from 3 sources: Bitcoin's volatility, the ETF structure, and the investor's position size. Read the prospectus. Compare permanent fees rather than temporary promotions. Understand the custodian and benchmark. Decide whether stock market trading hours fit your needs. And do not confuse convenience with safety. Bitcoin ETFs do not remove risk. They package it differently. And understanding that difference is how boring money wins.